The ProACT Know-How, brought to you by ProACT.
Hi, it's ProACT Sam. Welcome along to this episode of Living and Working Abroad, when we're examining the question is how can an expat retain their non-resident tax status when visiting the UK in a year? There's lots of different rules on your residency rights when you're visiting the UK from abroad, whether you're a UK expat or whether you're somebody visiting from another country and you don't want to become a UK tax resident in that year. And ties become the key thing. So if you've got less than 2 ties, you can spend up to 120 days in the country in that tax year. Now 120 days is 4 months. That might be sufficient and would enable you to live and go about your affairs at that time. However, if you've got more than 2 ties, then that number would come down to 90 days or less. The only way you can be absolutely certain of not becoming a tax resident in the UK in any tax year as an expat is spending less than 16 days in the UK. So if you want to enjoy investments in property, meet family, or oversee business in the UK, then you have to pay attention to what your restrictions are, what your ties are, and what your residency rights would be. So we as a business advising expat family and businesses, we look at how we can protect those assets and reduce the number of ties. If you've got less ties, then you can spend more or less days in the country. If you've got 1 tie, you could spend 182 days in the UK. But if you've got more than 2, if you've got 3 or more, then 90 days is generally the maximum. If you're working, you've got family, you've got accommodation, you've got business ties or work ties, all those things can affect your residency rights. How much time you spent in the UK in the previous tax year can have an impact on that. So just staying in the UK for 120 years is another tie for the following tax year. So there are exceptions that allow you to enjoy the opportunities that present at that time, but obviously the long-term solution, if you want to live and work in the UK, is a naturalisation process to gain citizenship. But that's not for this video. What we're looking at here is managing that short-term process in the current year. To reduce your ties, you can protect family and business assets by holding them at arm's length. So any family could have companies, trusts, holding companies that can hold assets abroad, and therefore the individual doesn't have the tax liability. So you could be in the UK with your worldwide tax liability, but if your overseas income is earned by a corporation, and there could be no income to be taxed back in the UK. But even if you own property in the UK and you're not generating any tax liability as an expat non-resident, you could still be caught for capital gains tax on disposals or inheritance tax on death based upon UK assets. While there's allowances, beyond those allowances, if you own a property for £1 million as an expat in London, you're going to suffer inheritance tax potentially by owning that property in your name on death. So all these aspects ProACT look at and use their know-how to advise expats living and working abroad how many days they can spend in the UK without affecting their residency rights to remain non-resident for tax status. We've got some guides available at our website, proactpartnership.com. Go along to those and see if you want to find out any more about that. If you do have a specific question, we'd love to hear from you. Contact us at our website, and maybe next time we'll feature your question on a Living and Working Abroad episode of ProACT Know-How.
The ProACT Know-How, brought to you by ProACT.